You know what time it is? It is the weekly live stream. Uh, it's 11 a.m. Eastern. You guys, we're gonna be here same time, same channel. Today's live stream is gonna be an amazing one because we're talking about real things that are happening in our business today. So this isn't no theory, no fluff here. We're gonna be very transparent in a recent BRRRR deal, how we got it financed on the front end, the private capital that was involved, and then at the back end when we went and refinanced with the bank. But there's a lot of good things happening in our community. A couple new students were onboarded yesterday and the day before. The community is growing. We're having we're kind of keeping this under wraps, but I'm in the studio here at the podcast studio. The podcast is going to be released very soon. So I know you guys have been waiting for that. We used to do a lot of podcasting a year ago. We're going to be bringing that back. And a lot of the students that we have are actually going to come in here and tell us their story and then their experience with us. So I'm excited to get caught up with them too, because they're crushing it, man. I was talking to Taylor the other day, and he's like, "Yeah, we got deals coming in. We're about to do this wholesale deal. Rehabs are going well." And I know you followed up with some of our past workshop clients as well. So there's a lot of good things happening in our community. That's the state we're in. How are you doing today, Dave?
I'm great. It's all about pumping out value. I have so much to say, I feel like, because it's like I used to be more of a consumer of social media, and I definitely feel like I'm more in the producer role now, meaning like, man, it's frustrating for me. Like my experience on social media anymore, there's just not a ton of value. There's really not. Like, it's a lot of junk. And a lot of what people are posting, respectfully, is just reposting other people's stuff. There's very
Yeah.
little originality. And, even like there was a realtor online, he's a friend, but he's like, posting, this is how hard it was, a post about how hard realtors work and this and that, but even that post was clearly copy and pasted. He didn't write that. It's just like, so really my intention and our intention is to be transparent, be authentic, be original, and produce value, and that's it. There's no
Yeah.
script, there's no like, copy and pasting, and this is like real life experience. It's like, this is what we do. I can show you a whiteboard in front of me with probably 30 addresses that are being worked on right now. These are properties that are either being fixed up, being rented out, or being sold. It's like, this is a day by day thing. We are constantly learning. We're not sitting in front of anyone with a huge ego saying, we know it all, this, that. We're still learning. As a matter of fact, I was just reading a book about multifamily investing this morning. This is what I'm working on today. Another cool thing that I wanted to share, everybody, is we want to produce a ton of value because we're family guys. RJ has children. I have children. And I feel this is specialized knowledge that we can all share with our children. This is not being taught at schools. What are they teaching in schools? I just had a conversation with a 9-year-old today, Lindsay's son, my stepson, and we were talking about algebra. How pointless is algebra? X minus A, it's just ridiculous. X minus A equals this, all these components.
You're not going to use it for real estate. That's
No, so I wanted to share this with you, RJ, and this is what I drew up for Cody today. And let me just explain this here real quick. See the little dollar sign up here? That's the bank. So what I said is we go to the bank and we borrow the money to buy the house. Then we rent the house out to this person who's going to pay us $2,000 a month. Our payment to the bank for the loan to buy the house is $1,000 per month. How much does that leave us?
What did he say?
He said $1,000. I said, well, guess what, son? That is all the math you're ever going to need to know in this life. Have a great day at school.
And basic, simple math.
Yeah.
Addition, subtraction.
And guess what else he figured out? So it's very easy. We go to the bank. We borrow the money to buy the house. Our payment to the bank to buy the house is $1,000. We rent the house for $2,000. How much is left over for us? He figured it out immediately, 1,000. And I said, now what if we do 100 of these? He's like, that's 100,000 a month. And I said, have a great day at school. When you come home, that's it. That's it, everybody. So this is what I want to teach. I'm passionate about teaching this, not only like to our children and our families, but like to each other. There's no shortage of deals. I went to a lacrosse game yesterday. I was sharing this with you, RJ. Yesterday, I ran into two people that I knew. Immediately, I jump into real estate because I want everybody to be doing this. This isn't like this like secret society here. It's like, let's build wealth, everybody. Like, it is our birthright. There's so much out there. There's so many deals out there. So I sent these direct messages to these people that I saw yesterday. I was like, look, any off-market opportunities that you find, send it over. I don't care if it's a gas station, a piece of land, a commercial property, or a residential property. If it's a deal, we're going to find a way to monetize it. And that's what we do as entrepreneurs. That's what RJ and I do. This is what we teach. So it is truly my passion. I'm grateful to be here. And today, I believe we're talking about probably one of the most important, and maybe the most important component of real estate investing and business in general. So my nephew, Gino, who will be in the office with us here eventually, was just recently accepted to Ohio State. RJ, I lost your camera, by the way. Think we lost RJ. This is must be an issue with his camera. But what I was just saying is my nephew Gino was recently accepted to The Ohio State University. And I told him point blank, I'm like, look, study finance. Study finance, because everything in business really boils down to finance. There's always a loan involved. If you're buying a business, if you're starting a business, if you're doing real estate, it really all comes down to finance and financing. So today we will be talking about the different forms of finance for real estate. And I don't even know if we're live. If we are live, let me know in the comments. RJ is back, I believe.
Back.
Yes.
All
so
right.
I believe financing is one of the most important things to discuss because it touches every aspect of business. I mean, if you're buying a business, there's financing involved. If you're working with customers for your business, there's financing involved, right? Think of how many, even if you owned a coffee shop, we were talking about the coffee business, and not a business we would want to be a part of, but a retail store or something like that. How many customers go in there and buy your product using a credit card? That's financing. If you're selling properties, the vast majority of the properties you sell, unless you're like a straight up wholesaler, and all you do is work with cash buyers. But even if it's a cash buyer, chances are it's probably a loan, a private loan or a hard money loan. Even cash offers are typically loans. Everything is financing. So that's why I think it's so important to talk about financing. And the 4 categories of financing, RJ, that we will be discussing is private money, hard money, DSCR loans, and then primary residence loans for real estate.
Yeah. And these are all, I mean, so we use a lot of private money, but we've used private money and hard money before to get a bigger deal done. And we'll go over that. But I would say 90% of our financing is that, because we built relationships over the years that allow us to, now we're at this stage now where we can just text our private lenders and they can see kind of the roundabout numbers, and then they'll say yes, and then we'll get the process started. There's even some lenders that we haven't even talked to in many, many, many years that, I mean, just like a quick text, they get involved like that. We haven't talked to this one lender, since 2018, maybe 19. That's like over 5 or 6 years.
Because
yeah, we're ready to go.
The track record begins to be built, and the track record comes from transparency, number one, but also just most of the private lenders that we work with, they know we're not going to present a deal unless it's a good deal, because we're not wasting our time with,
Yeah.
what do you think of this? It's very point blank. In fact, I shared on this last email when we raised 300,000 on a duplex that we're doing. I just did a whole screenshot of the MLS. I shared everything. It's like, look, here's full transparency. This is the game plan here, right? Here's the plan. We're going to buy it for this. This is the amount of work it's going to need. Here's the comparables that I'm using. Here's a map of how close these comparables are. Just be transparent. If it's a good deal, the money is there. If
It's
you're
true.
iffy about a deal, don't even waste your time with it. There's so many deals. You know what has set us back? I think, and I think a lot of businesses, this is part of learning lessons and whatnot, it's just messing around with iffy deals, wasting time, doing due diligence on things where it's like trying to force things to work, trying to, if because I get it, especially when somebody's just getting started, it's exciting. Real estate's exciting. I got a hot lead, and you really want things to work. But private money is, RJ, that's where we'll start out. We like private money for the simple reason it's very fast, right? So, as RJ just mentioned, we can send a text message because of our track record, and we can get a deal funded extremely quickly, faster than a hard money loan because there's no paperwork for us to fill out. And the private lender will also give us 100% financing. Probably the two biggest advantages for us as real estate investors to work with private lenders is the speed, and then the total amount of the money that we need. So that is all the acquisition and the rehab money. So a hard money loan,
Well, typically with private lenders, you're getting all of that money.
you're
So not
getting it
only
up.
is it fast, but you're getting the acquisition and the renovation money
Yep. So there's no
and the
down
way,
payment, no
right?
skin
There's
in the
no down
game.
payment, and then
And yep,
how we structure it, and it's something we teach in our community. We get paid, so more on that later. But that's what came about with the PYF method, which is pay yourself first.
correct. Yeah, you can actually work in yourself a fee if the deal is good enough and the deal allows you to do that. And you can only do that with a private lender. And a third ancillary little benefit here is when you're getting your rehab, not only do you get all the money that you need, but you get it all up front. So typically, even if a hard money lender is going to give you rehab funds, they're going to do it in draws, meaning you're going to start your project, then they're going to send out an inspector, then you got to submit a form and get more rehab money. They're going to do it in draws. It's a lot easier. It allows you to move more smoothly when you just get all your money up front. Time is money. You can keep your crew working. So that's the main benefits of using a private lender is the speed. It is getting 100% financing, all the money that you need. It's the ability to earn a fee if the deal allows you to do that through a wholesale fee. Pay yourself up front, get paid to buy the house, right? If the deal allows, and then finally getting all of your money up front so you don't have to mess with draws or wasting time with things like that. That is private money advantages. Disadvantages, typically it's going to be a higher rate. So you're going to pay a private lender 10, 12, maybe more percent. Don't worry so much about the interest rate. Focus more on the ease of doing business and the scalability of private lending. But you're going to get a lower rate from a hard money lender. We're going to segue into hard money, but they may offer you a lower rate, like 9.9% is typically what is going around for a hard money lender. But there is going to be more inspections. There's going to be more paperwork to fill out. They're probably going to make you personally guarantee the money, which is, it actually could affect your credit. They're going to want a down payment. So most lenders are only willing to give you 90% of the purchase price. So even if it's a home run deal, the house is worth 200, you're getting it for 100, right? They're only going to give you 90,000. They're only going to give you 90% of the purchase price. You still got to put that skin in the game, that 10K down. And I don't care how much money you have. If you're constantly putting your own money into deals, you will run out at some point,
Yeah.
right? I mean, this is the reality. So hard money is good if you don't have access to private lenders, but really you should be working on your network. And this is just what we were talking about with our community yesterday. I mean, you should be on your text messages. You should be working the DMs and working your text
Should.
messages
Yeah.
daily. And the way you do it is just letting people know that you're finding deals. And why not tell everybody that you're in real estate? This is like, be that identity. So private money is your number one thing. Hard money is good, but you got to put skin in the game. You got to put a down payment. And then you probably will have to deal with draws and rehab draws, which could be a little bit inconvenient.
And one of the biggest things why hard money is essential sometimes is because you're going to have access to more capital. When you start getting into more of like the West Coast markets and the East Coast markets where you're dealing with 500 million to 1.2, 1.5, 2 million, these are bigger deals and they require more money. And sometimes it's good to have access to hard money lenders that have a good process, and it's easy to do business with them because you need a higher dollar amount. Most private lenders that we have anywhere from 1 to about 500 in liquid cash, right?
Yeah.
So they can play. But when you start going into these bigger markets, you're going to need hard money because they're more like a bank. They're more an institution that have access to many many millions of dollars. So it's good to have both. For example, in this portfolio that we bought, we needed to have hard money to put up 80, I think it was 80 or 85% of it, and then we were able to structure the deal where that 20% for the down payment came from private lenders. So that's where you want to have both. So that private lender pool was only about the deal size was on that one day, it was like what, 16 million,
Correct.
13 million from hard money, and then 3 million from private lenders.
Correct. So sometimes
So
that's a great point. You could actually do a mixture of the two on bigger deals. But the big point that RJ just made is when you get into the bigger deals, typically you got to work with some kind of hard money lender or an institutional lender because they have so much money, right? A private lender, a run of the mill, day to day private lender is great for your typical single family home. Typically they're sitting on a bank account of 1 to 500 that they're interested in kind of investing with the private lending stuff. When you get into the bigger deals, that is where having a relationship with a hard money lender is going to be key. And let me just kind of reiterate something. This is the 9-year-old lesson of real estate investing that went down this morning before school. Remember, we go to the bank, we borrow the money to buy the house. Our payment on the money that we use to buy the house is $1,000 a month, and we rent the house out for $2,000 a month. How much does that leave us? It leaves us $1,000. This is the 9-year-old figured it out, right? Well, you know what part of this lesson was? At the end, when I said, hey, why don't we do 100 of these? Part of the lesson was, guess what? I told them, the bank has unlimited money. This is a mental blockage. People think like, oh, I can't do this. No, the bank literally has unlimited money. Everybody talks about money printing and this is the Federal Reserve. What do you think the Federal Reserve is? They're a bank. The banks have unlimited money. And the same thing goes with these hard money lenders. So when you're, dealing with a bigger price tag, sometimes you have to work with the hard money lender. And then sometimes you have a mixture of the two. So RJ just described a deal. We were purchasing for 16 million. The hard money lender was only willing to do 13 million. Remember, there you go. Hard money lenders, they want skin in the game.
Yeah.
But we didn't have to put the skin in the game from our pocket. We actually raised that from a private lender. But the thing to remember is the hard money lender, they're always going to be in first position, right? That's that first mortgage. So with that particular deal, or when you are raising private money for that gap funding or for the down payment money that you need for a hard money lender, you got to remember that that private lender is going to be in second position behind the hard money first.
Yep. And so sometimes you need both. A lot of the markets that we're in are in Ohio. And what's the average price in Ohio, Dave? You remember? I think we talked about it. Less
250.
than 250 at most. So we're playing in the affordable housing price points. So right now we're able to do what we're just talking about, to use private lenders, get 100% of the financing up front, and then get it stabilized. And stabilized means rehab, rented, and then take it to, now we're gonna, are we ready to segue into DSCR loans, Dave?
Yes, we are.
We're going to show you an example. So one that we did. So this one is all 100% funded with private lenders. This was last one we did on Hampton. And now what we're going to do is go and approach a bank or a mortgage broker who we have a really good relationship with. And she found us a smoking deal on a DSCR loan, right? And it still made sense. So DSCR loans, the benefit of that is the DSCR loans, we they're not, and you guys probably have seen this out there, the real estate investors that are buying properties, is that they don't necessarily look at your whole credit profile. They're looking at the deal itself, and they call it DSCR loans because as long as the property meets the DSCR requirements, then they will underwrite the deal, right? They'll underwrite the deal, and they know their rents are going to cover that principal and interest payment, right? So we
Yep.
like this DSCR loans, and because now it's, how many of these can you do? Just in that example that you showed Cody, why don't we do this 100 times?
Yeah.
With these
Yeah.
type of
And here's
loans?
the thing. I mean, so broad stroke, there's two ways to make money in real estate. You buy something or you rent something. I'm sorry, you flip something, you sell something, or you rent something. Sure, you could say there's a lot of ways to make money in real estate. We could earn management fees, we could do real estate commissions. There's broad stroke. We're either selling something or we're renting something. So the only reason we're really getting into the main broad stroke ways we're getting involved in a deal is to either flip it for a profit or to rent it out. So when we're buying an as-is property, we're going to use private money or hard money to buy this thing and get it fixed up. We just talked about borrowing acquisition money and rehab money. Well, after that, you're either going to sell it for a profit or you're going to refinance it. So the way we refinance it, there's really just two ways, right? I mean, there's a DSCR loan, which is what RJ is talking about, or there's like more of a conventional mortgage, which is like a local bank kind of deal. So the benefit to the DSCR loan is, first off, I mean, there's not a relationship. Here's the downside of a DSCR loan. And DSCR stands for debt service coverage ratio. All that means, everybody, is they are 100% underwriting and doing this loan based on the performance of the property, not the operator. They don't care about you. They only care that this is a good deal. It's more or less like I guess you could call it like more or less like an institutional hard money kind of refi loan, right? Because the rate is going to be higher. You're going to be paying 7.5% to 8%. The rate is higher than a local bank would be willing to give you, but they're so easy to work with. These DSCR loans, literally all you have to do is submit the information on the property. They're going to get it appraised, so they're going to have their valuation. All you got to do is submit a lease, and as long as this thing is producing enough money to meet their needs, and essentially they'll give you the money, so it's based on the performance of the property, these DSCR loans. But since it's so easy and since it's based on the performance of the property and not your track record, the rate is going to be a little bit higher, but it's okay. So we like it because it's so easy. We could rinse and repeat this thing. We don't even have to do anything. With these DSCR loans, we submit a bank statement, we submit a lease, they send their own appraiser out there, the deal closes. And we get the best LTV, meaning 75% loan to value. Sure, we pay a little bit higher of a rate, but guess what? Just like RJ said, we're in that affordable housing sector. You could still cash flow 7.5% and 8% money all day. And if you can't, you need to start looking at doing better deals, to be completely honest.
Better deals, but also how you structure the actual loan itself, because you can take it from, you can basically make it into an interest only loans.
Yeah, that's good too. It keeps your payment lower.
And then after, rents, because they go up, prices go up a little bit, you can then adjust it later down the road and turn it into principal and interest.
If you want to. You
If
could
you want
always
to.
pay more principal. You could set up every single loan as an interest only loan to keep your payment at the bare bones, the lowest amount possible. But if you choose to add an extra $100 on top of that payment, anything you pay above your interest payment is going to go to principal anyway. You can make any loan a PITI loan,
Yeah.
right? Instead of
Yeah.
an ITI loan, interest, taxes, and insurance. You could always add more principal.
Yeah.
So really, when we're doing these refis, there's two ways. You're either going to work with a DSCR lender, which is like a broker. They're going to charge you more fees. It's going to be a higher interest rate. They're going to charge you origination fees. Your fees may be lower with a local bank type of, because you have a relationship, especially if they kind of, now we're getting technical, but like if they keep their own paper in house and not sell that paper, to Fannie and Freddie, or like, if they don't sell their notes that they originate, all
Yeah.
these DSCR lenders, that's what they do. That's why they're so expensive. They earn origination fees, all this stuff. But that's how you do it. This is the third type of financing we're talking about, which is the BRRRR financing. We talked about private money, talked about hard money. Now we're talking about BRRRR money, which is going to be a DSCR loan or a local bank conventional type of refi. And with that, I mean, finally, the final part of lending here. I know we're real estate investors and we speak to a lot of real estate investors. This is pretty much, we've already discussed the type of financing we're going to use, for our investments, private money, hard money, and DSCR in BRRRR money. Well, we should still talk about primary residence money. And you might be thinking, well, Dave, why are we talking about primary residence money? We're investors. We're either renting or selling our stuff. Why do I care about primary residence money? Well, guess what? When you're selling properties, chances are you need to understand these loans because the people you're selling your properties to are using primary residence type of money. And we just had to,
FHA, conventional, and VA.
what are the benefits of each? So FHA, in a nutshell, is going to be a lower down payment program for the buyer. So the buyers probably have less money, probably less financially qualified, but still qualified for that FHA loan. Conventional is a bit stronger because they have at least 20% down in most cases. I know there's some other products coming out, and somebody was telling us at our meetup that there's a new product for conventional financing with less money down. It doesn't matter. It's the same thing. So a buyer using a conventional loan is typically more financially qualified than a buyer using an FHA loan. When we're selling our properties, we really don't care. We go with the
Yeah.
strongest offer based on what they're offering and whatnot. Sometimes
Yeah.
we care, but it
Well,
is
the one distinction is that the FHA and VA loan, you have to live in that property. So this is why it makes sense for somebody that's going to use this to get into real estate investing, because now you can use the house hack strategy, which I like the multifamily house hack strategy, because that's going to make you cash flow more, and then you get more units bang for your buck. But conventional, you don't have to live in there. You don't have to live in a property. It can be conventional loan is, the majority of our investors when we were selling a bunch of turnkey properties to used. But just I want to make sure that distinction's there, because if you're going to use these loans to execute, which is a phenomenal strategy, by the way, is FHA, you got to live in it. Same with VAs, VA loans. But still, I mean, you can get a good start in your real estate um, real estate investing business by utilizing these loans. It's got one of the most it's affordable. There's down payment assistance programs. There's all kinds of stuff with these loans. It's a great way to get into the business. Some of our students actually are doing this strategy right now, which is great. Kiana and Taylor, so um, we covered conventional loans, DSCR loans, hard money, private lenders. You guys see in the comments, I'm taking some notes down for these type of loans. But what else? What other loans that's it? That's pretty
That's
much
pretty
it.
much it. I mean, you can get into VA loans, which is another way for veterans to be able to buy a house and whatnot. I mean, you're only really concerned with primary residence type of financing if you're buying your own house that you're going to live in, or if you're selling to the retail market, which we do. So that's why it's important to still understand that. Really, the name of the game, how you're building wealth in this business that we're in, is going to be raising private money, buying as is off market smoke and deal properties, right? Paying yourself first, paying yourself upfront. You got such a good deal on this off market property upfront that you can actually make money when you buy, borrow all the money that you need to purchase this property, pay yourself a little bit, and get all the rehab money that you need, get the property fixed up, and then refinance this property with a DSCR lender or any lender that's going to give you permanent financing. Do a cash out refinance. When you do the refinance, when you do this refi, your private lender gets paid back. Now you have a permanent 30-year loan on this property, and ideally you are collecting some money at the closing table when you complete this refinance, when your private lender is getting paid back. This is the ultimate wealth building strategy. You made money up front, you're making money on the positive cash flow from the property, and you cashed out a little bit on the back end when you completed this refi, and you rinse and repeat. You do that over and over again. That is the ultimate way to build wealth. And I mean, we're talking about a couple different forms of financing. You got your purchase money and acquisition and rehab money, which is coming from a private lender or a hard money lender if you don't have any private money raised. And then you're doing the BRRRR financing, which is coming from like a DSCR lender or some type of lender that you have a bank relationship with. And that's it, guys. This is the buy and hold business explained. Or you're going to use purchase and acquisition and rehab money to buy something, fix it up, and then resell it for a profit. And that's it, man. That's the game.
So let's go over which example we're going to do. The one on Hampton. Let's do the one on Hampton. If you remember the numbers on it, I remember the payment was roughly, and this was principal and interest, was around $1,280.
I got something.
Right.
I got something for you, RJ. I'm about
What
to.
was? Yep.
Hang on 1 second here. I want you guys just to see the power of real estate, real quick. I'm going to share something with you, and normally we don't share this kind of stuff, but this is something that's happening this week. Let me share my screen here just for a moment. RJ, can you see my screen?
Yes.
All right. So we won't get into the details, but this is happening on 5/15, so 2 weeks from now. Loan amount, this is a refinance. The loan amount, new loan, is $236,000. The payoff to our private lender is $142. And I'll just bring your attention after fees and whatnot. Due to borrower, there's $89,000 in change coming to RJ and I in 2 weeks or less. From a refinance. This $89,000 is money that we could use for our families, for operating capital, whatever the case may be. And that money is 100% tax free. This is a positive cash flow property that we've acquired and fixed up with none of our own money whatsoever. And now we are cashing out a huge tax free dollar amount here in a couple weeks. Like, how many? And this is one property, everybody. This is one. I could show you numerous examples, and we will be showing a lot more examples soon. We're going to be really getting into our paperwork and showing you guys everything. We want you to know this business is the real deal. This is what we help people do, and you can do it, and you should be doing it. I mean, it is. Remember, I taught a 9-year-old. It's unlimited. Everybody, it's unlimited.
Yeah.
You're only limited by your ability to find deals. This is what we teach people to do.
And we teach people to also be conservative, because you don't want to, we talked about this earlier in the live, like you don't want to be pushing deals that don't make sense. It takes us a little bit more due diligence, and we're going, at our own speed. You don't need to follow our speed because we go pretty fast, but go at your own speed. Make sure
Yeah.
you're looking at lots of deals before one pops up where
Yes.
it makes financial sense, because that's what it is in this market. You got to really look at and be conservative with the rents. Look at other properties in the area, what it's, bedrooms and bathrooms, the style of your house. We'll go all over. This is stuff that we go over every week with our students, how to underwrite deals on rent, on rehab, purchase price, market, analytics. How many properties are listed on the market? What are they going for? Okay, what did the rehab look like? How many for sales and pendings? Days on market is super important. Plus, days on market for rent is super important, because the many days that a property is on the market is just as equally as important as on the market for sale and rent. That's the exit strategies here. You get paid when you sell something and you rent something out. So if you're going for an overinflated rental amount and it's been sitting for 90 days or more, that's 90 days of interest that you're paying to the bank that's coming out of pocket. So you want to be a little bit conservative on your rental amounts. You want to have a solid property, rehabbed really well, better than most. Because you're competing with a lot of Wall Street capital out there that started buying up homes, and they're overinflating their price, but their rehabs look terrible. So you can be the investor that has a solid rehab and not overinflating the rental amounts. So if the market rent is 1,500, well, why don't you go to like 1,470, 1,460, just a little bit below that? Makes a difference. So that's an amazing deal, by the way. That took us a little bit to, put together, and then wait for the market a little bit. But these deals are out there day to day, as long as you stay in the affordable type housing. That type of deal will not work out on the West Coast or East Coast. A lot of times they just don't pencil out. But I'm not saying that they aren't there. They are there. It's just going to take a little bit of digging around. So it's about that time, Dave. We gotta get some Q&A going. If you have any questions about this topic and subject, I think a lot of what was covered today was a lot of the questions that we get, typically about financing, how they work, what type of loans out there, what's available, when and how to use the financing to your advantage. What do they, what's the underwriting that's involved, application process and stuff like that. So if you have any questions, put them in the comments. We could spend the rest of this live stream answering your questions. Let me look here. Go ahead, Dave.
No, just get out there and do it. We're here for you. If you guys want to jump in, for our private coaching clients, we have a very active live chat. That's why I've been kind of looking at my phone a little bit. The chat's blowing up today. We got people doing deals. They're talking about paint color. We're talking about what's the best paint to use. This is the conversations you need to be part of, and we are helping people get their deals funded. We're helping people find new deals. We're helping them get sold. We have an amazing JV program for our clients where if you bring a deal to us and to the table, our dispositions or sales department is very strong, and we'll sell it and we can split the deal. I mean, we're living in abundance. You just gotta, if you're gonna do this, do it. I don't
Got a
know
question.
what to say.
Here's a good question. From someone on Instagram is asking, if you get approved for a DSCR loan, Dave, is that basically confirmation that you have a good deal?
Yeah, but you should know it's a good deal before you ever get to the place where you're putting it in front of a potential DSCR lender.
Absolutely.
Yeah, I mean, you got to know before you ever buy it with private money or hard money, you better know what you're doing. Underwriting is a huge thing that we do. In fact, this is the part of the call where I shamelessly promote our coaching because I believe in it so wholeheartedly. But we have a dedicated call once a week where all we do is help you underwrite your deals every Monday at 5.
Yeah.
So bring your deals. We're going to help you underwrite it so you know what a deal is and is not before getting involved. This is crucial to do this. If you're really going to do it, really, really do it, you got to learn how to find off-market deals, underwrite these deals, which we're here to help you with every step of the way, and then get them funded and then get them refied. The refi is the last step. of the due diligence. The refi is the final piece of this, not the first piece. So that's how I would answer that one, RJ.
And another one that I see, I think this one's on Facebook, is the DSCR requirements. What are you guys seeing for the requirements?
So it is based on the property, and it's based on how much income this property is producing. So the lender will look at, what your payment is going to be, and they want to see the income generated from this property is at least 1.25% minimum of your total payment. So the lenders, let's just pretend, the total payment on this thing is $1,200 per month. Punch into your calculator, and this is PITI,
Yep.
right? Or just interest only, taxes and insurance. Let's say 1,200, and just say in your calculator 1,200 plus 1.25% equals 1,215. Is that right? No. No. Here you go. 1,200 times 1.25 is 1,500. So they want to see this property is producing at least $1,500 per month.
Right.
So take your payment of what your payment is going to be at like a 7.5 or 8% interest rate, and then your loan broker will help you with this.
Oh yeah, we want to ask, like, what are the terms? What are the
Yeah.
DSCR terms? So then what you do is you look at the comps around the area of the property that you have, and you want to target the ones that, okay, are in that price point. Do they have the same bathrooms? You might need to add a bathroom, if not, to your house to get that rental amount. But the majority of the buy and holds that we do, we're typically looking to have an extra bathroom. This one, and actually the one that Dave showed you, we actually added another half bath. And then we also finished the attic so that they could use the extra space. And now we have more room in that property. So there's more value add to it. We also added a lot of the things that are more of amenities that people want to rent and pay that amount. So when you're looking at the rental comps, you also want to make sure you're looking at the quality of rehab inside the comps, do the pictures, right, inside the house. And then you can also look at your property and see, okay, well, what are the things that I'm going to need to add to make sure I get this this rental amount? Super important. We go all over this in our underwriting call. So anyways, any other questions? Let's see.
Got a few more minutes here, everybody, but I just want everybody to know this is an absolute pleasure. It is a gift to be able to have this opportunity to be in front of other people and share something that we are so passionate about.
Yeah.
I look forward to Wednesdays. I was thinking about Wednesday yesterday. I was thinking about, all right, we're going to do our live stream tomorrow. And it's exciting. And I guess, if there's no other questions, we'll start to put a bow on this. Just know there is an endless abundance of opportunities, wealth, love, joy, happiness. That is the point, guys. The point is to be happy. The point is to live a good life. And the only way you're not gonna kind of live a good life, it's up here. And what it comes down to, and it took me over 40 years to realize this stuff, we got to let go of the baggage. We got to let go of the stuff that's holding us back. And you know what it is? It's all the grudges and all the regrets. That's the stuff that's going to keep us kind of carrying sandbags around. Drop that stuff, let it go, and then just receive the information we're giving you, receive the information that you're getting elsewhere, and take action. This is what we're big on. Is RJ and I talk about
action.
A, B, C, D, E. A is for action. B is for bullshit, meaning remove it. And part of removing the bullshit from in between your ears is the grudges, is the competition, is the judgments, is the critique of other people, all of that. Just let it go. And then it brings you to C, which is collaboration. We would love the opportunity to collaborate with you. D is for discipline, which is every single day. We're at it every single day. This isn't Monday through Friday thing. We are constantly looking to collaborate. We are constantly removing the bullshit from in between our ears. We are constantly taking action, right? And then E is for energy, because at the end of the day, everything is energy, and you are going to get back in your life what you put out. The energy that you are putting out, the world is a mirror. It's not a window. It's going to reflect back. So stay with us. We got your back 100%. We'd love the opportunity to coach you, work with you. You know where to find us, and you definitely know where to find us next week. We'll be same channel, same
Same
time.
channel. Yeah. All right, y'all. See you.